Once the investment agreements are signed and the legal formalities are completed, the venture capital deal enters its final phase, the transfer of funds. At this stage, investors wire their capital to the startup, and founders begin integrating new stakeholders into the company's operations. While this phase might seem straightforward, it is one of the most critical steps in the fundraising process. The way funds are received, allocated, and managed, as well as how investor relations are established, can set the tone for a startup's next phase of growth. The transfer of funds isn't immediate after signing the investment agreements. It involves several steps before the money lands in the startup's bank account. Step 1. Satisfying closing conditions. Before funds are released, investors make sure all closing conditions are met, as outlined in the investment agreement. This can include securing regulatory approvals, if required, obtaining board resolutions approving the investment, finalizing cap table updates to reflect new shares issued to investors, and completing legal paperwork, such as intellectual property assignments or employee stock option plan (ESOP) updates. If any of these conditions aren't met, fund disbursement can be delayed, so founders should work proactively with legal and financial advisors to ensure everything is in order. Step 2. Setting up the fund transfer. Once all conditions are satisfied, the investors proceed with the transfer. This typically involves wiring the capital to the startup's designated bank account, sometimes via an escrow account for larger transactions, confirming receipt of funds, and executing the final ownership updates in legal filings. Financial records are also updated to reflect the new cash inflow and investor equity ownership. Step 3. Issuing shares to investors. After the funds are received, the company formally issues new shares or converts existing convertible notes or safes into equity to investors, which is then reflected in the cap table. This updated ownership structure is documented, and investors may request formal share certificates or legal proof of their equity stake. Step 4. Investor welcome and post-investment communication. Once the transaction is complete, founders should send an official investor welcome email to summarize the deal's completion and outline next steps. If applicable, they should share access to investor updates or dashboards. Founders should also schedule an introductory call or meeting to align on expectations, reporting cadence, and communication preferences. While the funds have been transferred, this stage marks the beginning of an ongoing relationship between investors and founders, not the end of the fundraising process. The closing and fund transfer phase marks the formal beginning of the investor-startup relationship. While the legal documents are signed and the capital is deployed, this step is not the conclusion of the deal. It's the starting point of oversight, alignment, and value creation. Why does this matter? As investors, how this phase is managed influences everything that follows: financial reporting, governance participation, strategic influence, and ultimately, the potential for return. Delays in closing conditions, lack of transparency in fund use, or unclear communication channels can signal operational weaknesses early. A smooth and well-managed closing process provides several key benefits for investors. First, it ensures that capital is deployed into a company with a compliant and updated structure, minimizing legal or administrative risk. Also, it provides immediate visibility into how the startup handles internal operations, financial controls, and investor relations. Finally, it lays the groundwork for a structured post-investment engagement, enabling better tracking of milestones, more effective board participation, and stronger influence on outcomes. In venture capital, writing the check is just the beginning. Post-closing execution offers an early indicator of whether the company can deliver on its strategy or whether active involvement may be required to protect the investment. For VCs, this phase is not passive. It's the moment where the real work of managing the investment begins.